You're listening to the Pursuing Alpha podcast, hosted by Charles Brandon Snyder.
Hey, Tom, it's good to have you, man.
Thank you.
I appreciate you.
Yeah, me too.
It's been a little time in the making to get you to come in here.
I
Your
know.
schedule is insane. I kind of feel for you a little bit.
It's all right. I mean, I love working, and I'm spending a little bit of time now mentoring younger people in the business, and so I love that. So I don't mind putting the time in.
That's good. So just quickly, introduce yourself, and then we'll jump back in that conversation we just had about you look good, so you've had a little bit of a change here.
Yeah, thank you. Yeah. Okay, I'm Tom Couture, some people say. Other people say Couture. It just depends on...
So what's the real way to say it?
The real way is Couture.
Is it really Couture?
Yeah, like, the company Juicy Couture or Randy Couture, the MMA fighter.
Yeah.
But, yeah, I am a dad of 5 kids and granddad of 7 kids, and my career is mortgage banking, currently at the Texas Tech Credit Union. Been there since 2011, and I know there's no way you're going to believe this, but this is my 48th year in the mortgage business.
That is insane.
I know. I don't look it right.
No, you don't look it at all, man. I look older than you do at this point.
You do not.
But hold on. When you say you're in the mortgage business, it's such an understatement because you were one of the top 10 in the country last year?
No, not top 10, top 1%.
Top 1%.
Yeah. Because, I mean, if you compared the size of
deals that you're doing.
Yeah, I would be way up there. But when they compare the whole country and you've got, California with $900,000 every deal, and that's a 1,200 square foot house. But top 1%, top in Lubbock. I'm the highest producing loan officer in Lubbock.
But how many deals do you normally do then?
So this past year, just under 400.
That is crazy.
It was about 104 million. And COVID year, when the market, the rates went way down, and me and one other person helping me did 579 loans in that year. And we worked from 6 in the morning till 11 o'clock at night, 7 days a week that year. Because we couldn't hire any help. It was COVID.
Right. You're boxed into it. You just had to. That is nuts.
So, but that year was an anomaly. 350 to 400 deals a year is pretty normal.
That is not normal.
Well, it's normal for me. Well, here's the thing. I love helping people, and I see giving people a mortgage to buy a home as a way to help them achieve their dream. And so I don't think transaction. I think people.
Right.
And that makes me, I think, a little bit more successful because people want to be cared for.
I do, and we've known each other for many, many years now, and done a lot of deals together. Personally, I've used you, and then on top of that is we have a good relationship with some of my clients that has gone to you. And that's been the common denominator with everybody that I send your way is like you actually care about the deal. And so it makes, from my standpoint, when, I always have to do the fiduciary deal where I send 3 people, right?
Yeah.
And we got to do that whole mantra with it. But the neat part of what I think that you do is it's not a transaction. It is more of a relationship, what they're trying to accomplish inside of there. You kind of help them walk through that. So I do appreciate that. So
yeah. And the other side of that is when someone like yourself or a realtor sends a deal my way, well, your reputation stands on that too. So you care about the people that are sending them to you as well as the people that you're helping get a mortgage.
Yeah, and that I would tell you in my profession, I didn't think about this until I was, a couple of years into my career. But then I started figuring out, man, if one of the guys that I send screws this up, the first phone call they're making is going, "Hey, Brennan, I know you sent me 2 or 3 guys, but this is the one we talked about, and it didn't go well, right?" And so it makes it. I've never had that happen, but I've heard guys getting in trouble doing it.
Well, and it's easy in the mortgage process to have glitches because there's so many rules and so many nuances to everybody's finances. So,
trust me, I know.
Yeah,
you
I've done yours. But honestly, you just have to. You expect that sometimes it happens, but you just have to handle it right. Communicate with the person. Tell them, "Hey, this came up. I think I can solve it this way. Are we cool?" it's the people that ignore the problems that get themselves in trouble.
Right, because they end up losing a whole lot when it comes out to it. Because, I mean, you got to put money down, you got escrow accounts. And so, I mean, and if deal doesn't go through, you lose that escrow. So I always start like high level, kind of getting done. And I like diving back into like what a mortgage is and how it works and what the different types and things to look out for. So there's so many ways that we can take this conversation.
Yeah.
But there's a lot that I kind of want to dig into because I've been thinking about this for weeks and weeks and weeks on end. And I think a mortgage is one of the most important things that people go out for. And there's so many sides to that. And I always say, if you look at it from two degrees, right, differently, it changes your perspective so much, right? Because I can tell you most people, and me and you've had this conversation, well, I'm just going to pay it off, Brendan. I'm going, you could just pay it off, right? I'm just paying it off. You're in the industry. You can just pay it off, right? But we've also come back and said, hey, carrying debt sometimes it's not a bad thing as long as you do it the right way. But let's talk about the right and the wrong way a little bit for 2 seconds and see what that looks like for you. So how do people go through a mortgage from just basics and we get on common ground here?
Well, now most everything is electronic. And I would say 80 to 90% of the deals I do, I don't ever meet the person face to face until I go to their closing.
I know it's changed a lot.
Yeah. So the process is you have to do an online application. And what happens in my world is I'll get a referral and I'll call that person right away and have a little short conversation with them, answer any upfront questions they might have, and point them to the online application. They fill it out. I have a team that if it's early in the day, by mid-afternoon, they've got it all worked up for me so that I can talk to the people again and say, you're pre-approved, or we need to jump these few hurdles. If it's at night, next morning, we get a pre-approval. Pre-approval means that from the front end, before all of the other nuances and documentation and all that is in, from the front end, you can qualify according to the high-level rules, mortgage rules. And so you get a pre-approval, and then you and your realtor can go make an offer on a house with that pre-approval. At our place, we go a little bit further at that front end, and we ask for that upfront documentation because I don't want to give a pre-approval that I can't stand behind, right?
Right. You give it kind of a little bit extra to make sure everything's there.
So then you put an offer on a house, and then there is copious amounts of paperwork that have to happen to get that mortgage all the way through to the end. Appraisal has to be ordered, title work for the long-term history of the title of the property. You put in the application what your income is, what your job history is, what your residence history is. We have to verify all that behind the scenes by sending forms out to employers. And of course, we pulled your credit already at the beginning. We can talk about that too. People get worried about pulling their credit.
Yeah, if it's a hard pull or a soft pull.
Yeah,
or
exactly. And we get the appraisal after, it takes 2 weeks maybe right now to get an appraisal. And then all of that is compiled. And if I've done my job right, when my team puts it in front of what we call an underwriter, the underwriter is going to look at everything in that package or that file and test it against the rules that of Fannie Mae, Freddie Mac for a conventional loan or FHA for an FHA loan. And they're going to come back and say, you did a good job. I think I might need one more document from you. And we go back and get it. And then the next thing that happens is you get a final disclosure of the numbers that you're going to go. You got an initial one in the beginning showing you all the fees, all the costs, all the down payment, all that. That initial one is then updated at the end because things change during the process. You know? I mean, we might say at the beginning that we're estimating your house appraisal is going to be $700, and if the appraiser only charges us $600, we're going to put the new number.
You're going to reflect whatever the changes are.
So then you get that that final number 3 days before your closing date, which is a federal law, and then you go to the title company and you sign 60 docs or so to.
It's a lot.
Yeah, it is.
All right, so let's unpack that a little bit because there's a lot there, and there's a lot to go inside of that, right? So the main things is like I want to look at is that process of what expectations are compared to what reality is, because I think expectations on a loan is way different than what reality is. And so I think it's extremely easy if you're a W-2 employee to get a house loan. If you're a business owner, which is mostly my clients, it gets extremely difficult in most cases or some cases because proving up employment is really difficult. So I want to, I'm not a CPA, I got to say that, but let's unpack some tax things here for a second, right?
Well, yeah.
So the biggest questions I always come to is like most CPAs will take for a business owner will use depreciation across the board, right? Will show extremely low W-2 wages because they're a Schedule S on side of their LLC, and they want wages low because they want to skip self-employment taxes. And so it makes it all come to passive incomes through the K-1 as draws and dividends and things like that, depending on the entity structure. So I always say getting into that box early on with guys, it's got to be a lot easier than it is after the fact because And what's the rules is if you're not in business for 2 years.
Yeah, right. So that's changed a little bit because all of the data that we collect, whether it's a self-employed person or a W-2 employee, all the data we collect is uploaded to an automated underwriting system, which is Fannie Mae is the big mortgage guru in Washington, and they have this software engine that tests every single piece of data that we put into a mortgage application to see if it fits the rules or not. So when it comes to that self-employed.
So what's the basic rules?
The basic rules are your usable income, I'm sorry, back that up. Your monthly debt load, not balances, but payments.
So it's called debt service coverage ratio in my world, but you usually call it debt to income ratio.
Yeah, right. Well,
so it's the payments that you're making on your debt equal to how much salary or monthly income that you're bringing in.
Right. So the payments you have on all your debt plus the new house payment.
Oh, you add that into it on top of it.
Right. And that can't exceed 50% of your gross monthly income if you're W-2 or your bottom line with a self-employed person. So a lot to unpack is right because on a self-employed guy, that bottom line at the bottom of his tax return, AGI,
could be negative.
Could be negative. It could be just really small. Any depreciation, equipment depreciation, vehicle depreciation,
179 deduction, whatever you're looking at.
Not necessarily 179.
Really? Y'all don't even account for 179 accelerated depreciation?
Please don't say y'all. It's the rules from Washington.
Good point, Tom.
Yeah.
Sorry. Hey, Ryan, I'm already burning up, brother.
Yeah, it's hot.
Yeah, can you open that door? I don't know what it is about this room.
It's the lights. It's got to be the lights.
But that will cool us off real quickly. We just might have Harrison screaming in the background, but it's all right. But you're right. So the rules will say that you have to have a debt service coverage ratio, including your mortgage payment, to be 50% in excess of what the debt is. So if my mortgage is $1,000 a month, I got to be making at least clearing $2,000 a month.
Right. Well, mortgage plus your other monthly payments. So if I have a car and a credit card and a house, my new house and student loan, all those payments added together, they're $2,500, which is facetious, but $2,500.
Correct.
I got to be making at least $5,000 a month to qualify.
Do y'all take into account passive income streams then?
If they're on the tax return.
Yeah.
Yeah.
So if you have multiple entities, like just take me for example, right? We have multiple real estate entities.
Yep.
And so this entity, we might have a conventional mortgage, real estate mortgage on it, because it's a commercial property. And, we call it debt service coverage ratio, and it's generating $120,000 in gross revenue, but $80,000 of it's going to a mortgage on it. We're cash flowing $40,000 at the end of the year, right?
Yeah, as long as that $40,000 shows up on a tax return, I can.
And
count
it carries through,
Yep.
and as it carries through, as passive income inside of there.
Yep.
Okay, so that's the biggest, and that's why I wanted to get to that. That's the biggest question I probably have. Is there everybody saying, hey, there's all these different entities. There's Schedule E, right? There's 1040. Right, and you got farmers. I just dredge them when I'm going.
Yeah,
I love these guys together, but that Schedule F is detrimental sometimes.
Right, but most farmers have a huge depreciation for equipment that we can add back to their bottom line. Depreciation on equipment or vehicles, I don't care if it's $250,000. I can count that as income. So if their bottom line on the farm is a negative $100,000, and they got 250 in depreciation, they now have $150,000 of income I can count toward their debt service coverage ratio.
Yeah, that's crazy. And most people don't call it debt service coverage ratio. That's more on the CFA side. It's debt to income ratio.
Debt to income,
Yeah.
Which is easy if you think about it. Debt payments as a percentage of your gross income.
It's got to exceed 50%.
Be less than 50%.
Or be less than 50%. Yeah. So I think that's number one rule.
That's number one. Credit scores are a big deal now. I remember the day when you would look at somebody and see, kind of what their debt service ratio or debt to income ratio was, and have they made their payments on time, and you could approve them.
Well, that was 2008, though. That's what got us in trouble in 2008, wasn't it?
No, we were using credit scores in 2008.
That's the catalyst that created it. But the other part is they not only did they start shorting the market, but then they started doing, what they called mortgage-backed securities or MBSs. And those MBSs, there's so many certain amount of securities you can put inside there. So,
I don't understand what this was, you will, but there was something then called swaps, MBS swaps. That's what really...
Well, you get into that, and then you start getting into synthetics, and then you started to get into all these things where they were betting, there wasn't enough of these products to go around, so they started kind of falsifying the credit ratings inside them, and that's kind of what tipped it over. But even on top of that, they just started betting on the bet itself. So that was like 100-to-1 bet. So, hey, I'm going to bet that this mortgage isn't, this tranche of mortgages isn't going to work, and so I'm going to go out here and start magnifying that with derivatives. And those derivatives would come in there, and when this fell, there's billions of dollars backing up those derivatives that just started snowballing. And
there was no way to stop it.
There was no way to stop it. So I think we learned, and the Dodd-Frank rules came out of this, right?
Yeah, Chris Dodd and Barney Frank.
Barney Frank, and which is a Democrat. And I got to give him a lot of credit there, and I don't give Democrats credit a whole lot, but that was actually one that I think all of that could have been prevented. Here's the problem that I see, and this is just me from outside. So I'm not educated deep enough in this to actually making it a recommendation or anything. But in my opinion, this is all could have been stopped if you would have separated the wealth side and the institutional investing side from the banking industry, and that was done way before, right? But as soon as they broke that bridge where bank institutions could play on both sides of it, then there was no checks and balances to see if they're betting against their own investments.
Right.
And as soon as that happens, you got problems.
Yeah, right.
And here you go. You got 2008.
Right.
So, and now we're in a funky, weird way of that, where now we're looking at, $7 trillion roughly that was poured onto the U.S. economy in 2020 during COVID. Yeah, we were talking about this before we went online. The M1 money supply reports is skyrocketed. Ron, do you have that graph? I think you have that graph.
I do indeed.
And so that is insane. So we were at $4 trillion, and then it went up on January 22. I mean, it exceeded 21 trillion. I mean, we went from less than 4 trillion.
Well, look at it. Just from January to not even July, January to March of 2020, it went from 4 up to 16.
If you're just you're quadrupled just in that short period of time. But if
is all the stimulus.
It's all the stimulus.
Yeah,
right.
we printed money and printed money and printed money and handed it out and handed it out, and people started living off of that money
instead of saving it. And this is you can't shut down the economy, especially in some of these states the way that they did and didn't expect that. But then you created the first, and everybody talks about this, where it's what are they calling it now? It's guaranteed income. It's Ryan. Oh, they're big on this. And this was the first case where everybody gets a guaranteed income.
Oh.
And so it's they call it. It's not guaranteed income. Yeah, it's UBI. Thank you. It's not QBI, but UBI, Universal Basic Income, right? And so I think this was the best trial run. It's a horrible trial run, but we actually literally tried this where everybody got a unified basic income. And they did it through the stimulus package to test this thing out. And what did they figure out? People are lazy.
Yeah.
And they're not going to do anything with their lives. And now you can't get them to go back to work.
Yeah.
And even today, in 2023, you're having these major companies fighting everybody going, hey, I don't want to go back to the office. I just want to work from home. And I want to work 6 hours a week, 4 hours a week. And I'm blessed because the guys that work with me and for me and around me all want to do this because they have a passion for it. So I never have to question that. But I look at some of these other companies that I talk to and going, man, I can't get anybody that wants to work. And I think it changed the culture. Some of it's for the good, but a lot of it for the bad.
Yeah.
And it's crazy. Have you seen the UBI? Have you looked into that? Have you?
I know what it is, but I haven't really studied it that much. But it wasn't it an experiment in socialism?
Yeah, pretty much. I mean, it's literally going back to that motto. It never works out for any country that actually does it.
No.
And you look at everybody right now, and they're like, it's changed the mentality of people to, hey, get up and go and work. And I think the good Lord makes us where today's, if you go to work and you do good things, but you try to make today better than yesterday and tomorrow better than today, but you got to have that get up and go to work kind of mentality.
Yeah.
And that's the part where I just kind of get off on it.
I know. I think that especially young people have never had to, or have never really experienced anything else. You take a 25-year-old right now, and 2 years ago, 3 years ago, coming up, they started getting free money handed to them. Well, why not? That was their attitude.
Yeah, why not? Go down that deal, and we're looking at this on paying for college too, and and that's been a huge narrative there, and and it's just like a mortgage to me. You're not going to figure out and fix the college system and debt, trying to put a Band-Aid on it. And when you try to pay off these debt, that doesn't fix anything. All you're doing is paying off the debt, and you're going to have that debt resurface 4 years from now.
Yeah, right.
They're typically state-run organizations. You want to fix it, cut out the bloat that's inside these universities.
Exactly.
I mean, you go look at the inflation on a university cost from 1980 to, it's up like 400%. I don't know what that figure is, Ron, but I think it's 10 times worse than inflation. Well, so it doesn't make sense. And if you go look at the universities, it's insane.
Well, could you run your business bloated like that and actually make money, or would you be out of business?
Yeah, I'd be out of business, right?
Because the government's not going to prop you up, but they sort of have to prop up the education system.
And they don't really. I think there ought to be whatever your endowment is, and this is where I'm deeply against it. Whatever your endowment is should offset what the government deals. So you can't go to these huge institutions that have, hundreds of billions of dollars inside of an endowment and still get government subsidies because you're state-run school, but you have all this free money that's coming into your endowment that's not taxed. Yeah. There's so many things, and I'm a conservative when it comes to a lot of these things, but it does not make sense anymore. So,
well, don't you think the tax code needs to be changed?
There's no way to fix it.
No.
A flat tax won't fix it. There's no way to fix it. The only thing that you can, and here's why it won't ever be fixed, is where are the smartest people in the world work?
Where? For themselves?
In finance.
Oh, in finance, yeah.
The smartest people in the world, because of the money, is in finance, right? The smartest people in the world are not government politicians.
Yeah, right.
Right?
Yeah.
I think we've proven that over the last couple of years, right?
Yeah.
Right. And so it's if you don't have the smartest people that can actually go in there and figure it out, they're always not going to think comprehensive enough that the smartest people to find the loopholes in it. And they're not going to come in there and create a flat tax. I mean, that's just not going to work. And even if you did, they're going to find a way around it because somebody's going to get their palm greased, and there's going to be a benefit one way or the other. So I think the tax code does need to be reformed. It's just never going to be reformed in the way that we actually thought about it.
Yeah.
Hey, swing it back. I know that was kind of a...
Yeah, we got off.
We got off, and I love doing that too. But it's a good get off, though, because I think understanding what went wrong, do you think that's going to happen again?
No, I do think that Dodd-Frank, back to what you said, I think it puts some safeguards in there. Now, there's still the crossover between the banks and the investment firms, but when it comes to lending, we have probably, well, I shouldn't say probably, we have the highest quality portfolio of mortgage loans nationwide than we've had in the last 25 years because all of those guidelines were brought back in. And you don't have to, you can get a mortgage with 5% down or a FHA mortgage with 3.5% down. So it's not like back in the 70s or 60s where you had to have 20% down payment.
So unpack that really quick, right? Because there is a benefit to going one way or the other.
Sure. Yeah.
So
Well,
the 3-5%, you can get a loan, and what type of loan is that?
that's an FHA loan,
And an FHA loan stands for what?
a Federal Housing Authority, and originally it was to help people that could not buy a home or had never bought a home any other way. Back in, I think it was 1938. What was that dude's name? Roosevelt, that president. He started it, and because at the time banks were lending money to buy homes, and they required people to put 20% down, and your average young person getting married couldn't come up with 20% down until a lot of years into their marriage.
Mm-hmm.
So the FHA came along and said, we can help people get in homes by letting them have a lower down payment. And there's an insurance fund set up by the government.
That's where I was fixing to go.
Yeah, called the FHA Insurance Fund. So in an FHA loan, you're charged a fee up front of 1.75% of your loan amount that's added to your loan. You don't have to pay that in cash. But
Is it a one-time fee or recurring?
that part's a one-time fee, but then there's a recurring fee as well. That's
PMI, right?
Yeah, and in FHA world, they have to do everything different. So it's MIP, Mortgage Insurance Premium.
Okay.
So
And
that
how much is that typically?
that has been 0.85% of your loan amount divided by 12 added to your payment, right?
But it's recurring every year, right?
Yes.
Until you hit the 20% mark.
Not on FHA. On FHA,
Oh,
it's there
wow.
for the life of the loan.
I did not know that.
And it just recently got lowered to 0.55 from 0.85, so it's a little more affordable because, back to what I was saying, the portfolio of mortgages that's out there being paid for now is so much more quality, credit quality, higher credit quality, that there hasn't been near the foreclosures. You look on CNBC or Fox Business or whatever, and they're going to say, oh my God, the foreclosure rate has gone up. You know, it's like, well, this is what's wrong with 24-hour news cycle. Sorry, I'm going to get in trouble here.
No, I
but,
think you're right. They got to make
but-
everything a catastrophic event,
Right,
or
'cause
they
they-
wouldn't have anything to report.
And they wouldn't have ratings enough
Right.
to get advertisers. But they're saying foreclosure rates are really high right now compared to last
What?
year,
Yeah.
the year before. Guess what?
There was all that stimulus.
And there was a moratorium on foreclosures during COVID.
I totally forgot about
You
that.
could not foreclose a house. So, of course, 3 foreclosures is 300% higher than 2 years ago because you couldn't have any foreclosures then. So, back to the point, though. The FHA Insurance Fund then has a lot of excess money in it right now because they haven't had to. What happens in a foreclosure of an FHA loan or a conventional loan that has PMI, which is a privately held insurance,
What's PMI stand for, so people?
private mortgage insurance.
Okay, so all right.
And either one of those insures the lender against you defaulting on the loan.
Okay.
And you pay for it.
Right.
Great deal for you.
Yeah, no
Right.
kidding. You pay for the own insurance. Make sure you don't default.
Yeah, and if you're a person who's never defaulted, it's a big waste of money.
Yep.
But on either case, if you did default and I had to go foreclose your loan, if I lost money as a bank or a mortgage company, some portion of that loss is paid back to me from those insurance policies.
How much of that?
Well, it's different on every situation.
Give me an
but
average. Give me a range.
22% of the
Roughly.
loss. Yeah.
It's paid back.
Yeah.
So I
So-
love it. So they put insurance that we have to pay for just to cover the institutions that are making money off of
Right.
us.
Right. Which there's a positive side to that coin, though, because people whose maybe credit quality isn't quite as high.
So what's a good or bad credit quality to get a one in your world? So we
Well-
can define that real quick.
Well, if you're talking about credit score,
No, I'm just saying, like, what's it going to take for me to qualify for a mortgage minimum? What's my credit score have to be?
Minimum
Mm-hmm.
in my world 600.
Okay.
Some companies on an FHA loan can go down to 560. We don't because they're really hard to get approved. But
So what's the range in the credit scoring? So if you're at 560 to 600 where you're at, what's the lowest your credit score can go?
the lowest credit score you can get,
Yeah.
in the 400s.
Yeah, it's around 400, I
Yeah.
thought, right?
Yeah.
And the highest?
8. Well, the highest possible is about 835.
Okay.
But they never give anybody an 835. So the highest I see is maybe 810, 819.
Right.
That's a stellar person who's never made a late payment. They don't overutilize their revolving credit, And
That's a big one, by the way.
that's a huge one, because your credit score is highly affected by how much of your revolving credit limit you use. So
And you want to stay below what?
30%.
I think this is the key people need to recognize.
Yeah.
So if you have $10,000 in a credit line, you should never spend more than $3,000 of that every single month, and you got to pay it off every month.
Yeah. Yeah. If you go up over 3% or 3,000 or 3,300, 30%, and you stay higher than that, they're going to ding your credit score. The algorithms will say they're living off of credit, and we got to lower their score.
Even though that it's paid off, this is what's insane to me. Even though that, like, I go 50%, right?
Yep.
But I pay it off, and I never ever go every single month, right? Because we run a business off of we'll have to do a podcast on this, on when to effectively use a credit card and what the benefits are, because it's just a big game.
It is a game.
Right? Because you can get all these benefits by using a credit card, but people are afraid to have credit cards because they hear all the horror stories, because if you're responsible with it and you pay it off and you just use it as a revolving line that you pay off every single month, you can get a percentage of that money that you put on that line back.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
So I have a American Airlines credit card.
Yeah.
I don't keep a balance on it, but I use it to pay everything except my mortgage, because mortgage companies won't let you pay with a credit card in case it gets denied.
Decline. Yep.
Yeah. So during the month, when the bills are adding up and the credit card balance goes up, my score goes down. On payday, when I pay it off, my score goes back up, and it can fluctuate 20 or 30 points.
It does. It's crazy.
Yeah.
It's good.
Yeah. But that's just because, and the same thing with trading, you can verify this. It's because the algorithms can't dig down in deeper than the top line of things. So if your balance is more than 30%, that algorithm says, "Oh, that guy's a risk. He's got to have a lower score."
And I think this is where AI and some other things are going to come in and step in. And so I think they're going to go, "Oh, this guy takes it to here and then pays it off, and then takes it to here," and they're going to start seeing those patterns.
Yep.
And I think that's going to
That'll
change
help.
over time.
Yeah.
And let's see if that happens, because I think it really does, because it really does hurt the business owner. Because that's, like, we have so many credit cards. I think we're up to like 4, right? And everyone has a different purpose.
Yeah.
And so I have like a Costco card, right? And we put things on there just on personal for trips and things that are more efficient that you get. And then I have a 2% back card. And then I have a company card that we get like 2% back on. And at the end of the year, we end up we have an annual planning trip that we take the whole team on. Well, we just use the points off of there to take the annual planning trip, right? And so it's one of those things. If it's used right, it's really good. But I think most people don't understand that it impacts you.
Yeah.
And they see it as like, hey, that's future money that I'm going to use today, and I'll figure out how to pay it off. But most credit card companies make 15 to 30%
Plus transaction fees.
Now the transaction fees are on the consumer side.
Yeah.
I mean, on the company sides.
On the vendor.
On the vendor side.
The retail person you're buying from or whatever.
Right. So they pay between 1.5% and 4% just to process that transaction. And I think this is where some of the cryptocurrencies are really stepping in. I can't get into that narrative, right?
Yeah,
because that's one of the limitations of having this podcast and being registered.
Yep.
But some of the middleman, I think, is what's going to be taken out in the future because of that, because the processing fees and the transaction fees are so high that adds up to being billions and trillions of dollars.
Well, yeah, because like a credit card company doesn't make a penny off of me on interest, because I pay it off before any interest accrues. But they make a lot on every transaction from that vendor.
Yeah, they make 4 or 5% on there, and now they pay me 2% back, because I won't even touch a credit card unless I get 2% back. So I'm like, that's kind of my standard. Is it 2%? Nope. All right. And so I always looking for the ones that are paying me 4 or 5 or 6% on, hey, put $6,000 in gas and get 6% back, right? All right, cool. So we set a limit to $6,000 until we hit that limit, then we switch it over, right? So you can game the system, because that's what they're doing for you, right? And game the system to get the maximum amount. Why not? They're giving it to you, and if they're going to make trillions of dollars on the transfer of wealth. you might as well just get a piece of that if you do it the right way.
Yeah,
So,
right.
so how's that affect you? So we went into, all right, so one is the 20% down. So I always look at it and have a conversation that PMI is a cost. It's a recurring cost until you hit 20%. I didn't know FHA loans that it never comes off.
Yeah, right.
But it's a good starter. So does that mean people with an FHA loan, should they refinance?
Yeah, if rates on the conventional loan later on are low enough for them to benefit from a refinance. But you have to, so the way I look at it is if your FHA loan rate is 5.25 and the PM or the MIP portion is 0.55, so now you're at what, 5.7?
Yeah, or 5.7, right. Whatever. Yeah, it's 5.25 and plus 5.5. It's 5.75.
5.8, yeah.
Yeah, 5.8.
Well, you're not going to want to refi unless that out of the FHA unless that conventional rate without PMI is going to be less than 5.8. So don't just look at rate. You look at rate plus PMI because you're trying to get rid of that PMI, right?
Right.
So
but you got to have 20% equity in your home in order, or is it 25% equity?
20. If you refi to a conventional loan, your equity has to be at least 20%, or else you're not going to get that PMI.
But is that equity on the original price you bought it at?
No, the new
because
appraisal.
You go to a new appraisal when you refinance, so they're actually going to give you today's value, right?
Yeah.
So if I have a house for 3 years and it appreciates at 3 or 4%, and I got 12% of equity just in, hypothetically, just inside of my home, and then I've paid that mortgage down, I could have 15% equity after 3 years.
Originally, you had somewhere between a 3.5% and 10% down payment, so you already had that equity too.
So you could have 20% inside of it real quickly.
Exactly, and then you look at refinancing. There's a cost to refinance, about $3,000 or so. But if you're going to lower your rate enough so that, what I like to tell people is, no sweat if you're going to your lower payment is going to pay back the investment of the $3,000 in a year or less. Do it. If it's 2 years, let's look at it and see. And if it's going to take you 5 years to pay back that $3,000, you may not live in that house for 5 more years. So don't refinance.
Man, that's a good subject right there.
Put the fees to refinance onto the principal and save a little of interest on your current loan. And so every time somebody comes in to talk about refinance, we compare those numbers. Because I am not going to refinance somebody just because, a 5-handle rate sounds better than a 6-handle rate, right? I'm going to look at the numbers and say, this is not a wise financial decision.
So you act almost like a planner to a certain stance. You actually do a compare for the mortgage. You compare everything to it. You write it down. It's black and white. This is how it saves you. How it's done. You said something right there is how, and you probably know this, how long do people actually stay in their homes now?
Average is about 7 years.
Really?
Yeah. So some people a lot longer, some people a year. But the average in the United States is about 7 years, which is why you can watch interest rates and on 30-year mortgage loans and compare it to the 10-year Treasury because they're close number. The 10-year Treasury is going to expire or what's the word? Not expire, but mature in 10 years. And if your mortgage is going to pay off in somewhere between 7 and 10 years, that's why those rates kind of
track each other there.
Yeah, they're not the same like right now.
No, but they're correlated, so you can actually see
historically by about a spread of 2 points, 200 basis points, 250 basis points. So if you see historically, you see a 10-year Treasury at 3%, mortgage rates are going to be somewhere between 5 and 5.5. Right now, it's been a little wider because of all the, I'll say it nicely, all the stuff that happened over the last couple of years.
That wasn't nicely. That was very nicely.
Yeah, well, whatever. Yeah. So it's a little bit wider spread right now, but it's coming back. And I mean, we could talk about rates for 2 hours, but the bottom line is, and I really wanted to get to this, unless you have something else.
No, go.
So many people think that when the Fed raises the rate, that automatically means mortgage rates are going to go up, and it does not.
Yeah, so they don't understand, and this is a good thing where I can jump in and kind of give you, because we study this every single day. So the Fed only controls the Fed fund rate, right? And it's like they control that when they issue that rate, and then the market controls everything after that.
Well, no, not exactly. Because the Fed funds rate is defined as the interest rate that a Fed member bank is allowed to charge a non-Fed member bank
correct
to borrow money overnight. So think about this. If I'm Tom's little bank and you're Brandon's big bank and you belong to the Fed and I don't, just to break this down to where people can understand.
No, I love it.
You belong to the Fed and I don't. So I loan out 20 car loans today because for some reason everybody's buying cars. I don't have enough cash in my vault to cover all that. So I have to go to Brandon and say, Brandon, I've got to borrow some money overnight until I can rearrange all my balance sheet stuff and whatnot.
Pay everything off, get everything squared.
Right. So your bank loans my bank, whatever, $100,000 to cover what I didn't have. Your bank is only allowed to charge me the Fed funds rate at my bank. But if the Fed funds rate that I'm paying you overnight, because I'm that guy, that bank that has to borrow all the time because I do a lot of business and I don't have enough deposits to cover the money I'm loaning out. And so I'm borrowing all the time. A year ago, or a little over a year ago, you were only getting to charge me 1/4 to 0.5% on the money I borrowed from you. Today, you're getting to charge me 4.25% or 4.5%, right?
Right, because that's the Fed rate.
Right. So, but how's that going to affect the consumer? When I'm having to pay you to borrow that money overnight, I got to raise the rate on my car loans, on my personal loans that I'm giving to the consumers out there. So that Fed funds rate can affect commercial loans, credit card loans, car loans, personal loans, any of those kind of consumer type loans and commercial loans that a bank loans out because they have to raise their rate to cover what they're
borrowing from the Fed.
Right. So then what you said comes into play right after.
Yeah, so here's the other side of that coin. This is the point I'm getting at. So the Fed fund rate here, but the market controls anything after that.
Right.
So in my world, you got the 2s, the 10s, right, the 20s, right? And so those are durations of time. So as a consumer, right, if I'm going to borrow or loan you money for 20 years, I want a higher interest rate than if I'm going to loan you money at 2 years.
Yep, exactly.
And that's a grid, right?
Yes.
And so typically that yield curve is where we're getting to. Thank you, right?
Yeah.
And so that yield curve naturally will be higher. So my 30-year mortgage is going to be at a higher rate than what my 2-year.
Because when you loan that to me, you're tying that money up for too long of a time.
It's opportunity cost is what we call it. So the opportunity cost for me to go make money somewhere else for the next 30 years is gone, right? So I want a higher interest off of that money. Well, that's where the market controls that.
Exactly.
Here's where we're at today in a recession.
Yeah.
So I don't know what the stat is, but 80-90% of the time that yield curve inverts, right? So now I'm getting a higher interest rate on things that are very short rates than I am on my 30 rates. It's automatic recession.
Yeah, exactly.
And we've done that, last year. We were inverting the yield curve, right? Our 2 and 10's inverted, and now everything's inverted. And so you don't really come out of that because what's happening is the Fed is increasing rates faster than what the market in the street is actually increasing their rates.
Exactly.
And so, like you said, a 0.5% rate went to 4.25%, right? That's a huge jump when all of the long-term debt was already at 3 or 4. So now those things are inverted, right? And now we're in a whole lot of trouble here. But this is what scares the piss out of me. I had a deep conversation with, we have a chief economist here, Dr. Starr, Brian, he's going to be on. Brian, we got to get him on quick. And I literally said, Brian, what are we going to do? So you said last year, and this is a good point, that the Fed fund rate was 1/4 or 0.5%. A year ago, the United States is $52 trillion in debt. And that we're paying 0.5 or 1% in interest rates on that alone. Now they're fixing to pay 4%. So we were paying $350 billion in interest-only loans last year. We're fixing to pay $1.2 trillion. That is insane. So I'm not saying the market's going to crash and the world's going to end and all this other stuff because not only the United States is in a deficit, but this is what Dr. Starr explained. It's global. Every country's in a deficit. right? So we're printing money, we're devaluing our currency on a global level that is unprecedented in history.
Yep.
And I think this is going to be a big, big problem. But this is why I also think that hard assets is one of the best things that you can buy and you can own.
Yep.
And I know this is probably outside your wheelhouse, but I'm going to ask you, discount rates on debt is something a lot of people don't even understand.
Yeah, right.
So if I take a loan out and I borrow money, right, $500,000 for a loan, and then I go 20 years, what the value of that $500,000 loan is now worth less because our dollar's worth less.
Right, exactly. Yep.
Right? And so when you start applying discount rates to currencies, this is why I think people make a deep mistake in not carrying debt.
Yeah.
And I carry debt, or I don't recommend anything, but I look and have a conversation with a lot of our planning clients on carrying debt, because you want to carry debt because that debt actually devalues over time.
Yeah, right.
Because in inflation, a $500,000 loan today seems like a whole lot of money. $500,000 loan 20 years from now, when inflation's at 4%, is not that much money.
Yeah, right.
Does that make sense?
Yeah, makes perfect sense.
It's a completely different world. But I view debt as if I have an asset that has a high probability of making me 4 to 6 or 8%,
Yeah, offsetting that debt.
offsetting that debt is what's the important part. So if I have a $500,000 in a brokerage account that makes me 10% return, hypothetically, and I turn around and use the gains off of that 10% to pay my debt off, and then if a bank pisses me off, I got a $500,000. I could just write them a check and say, you're done.
Yeah.
You know what I'm saying?
Yeah, right.
So you're actually in control of the bank.
That's
the
the
bank's
smart
not in
money.
control of you. That's smart money. That's really where the wealthy goes into. But we're getting off. I love that conversation because I actually think nobody understands how money is circulated in the industry. So if my question on this is, do you believe that we should stop, like when interest rates go up this high, should we stop buying houses?
No, absolutely not.
So
100% disagree.
Why?
Because the appreciating value of that real estate is, rates are going to come down at some point.
I agree with you,
that
100%.
is the way the world works, or the economic world works. We have to weather this storm. So right now, you know, if even an investment property, which is a higher rate than if you're going to live in the house, that two things are going to happen. If you wait till next year or the year after, some people waiting in hopes that then they'll get a 5% rate instead of a 6 3/4, and other people waiting because they're afraid and they want their money somewhere, you know, safe, like in their pillow, which isn't a safe place to put your money, by the way, because
now with 6% inflation,
yeah, right, the dollar's being devalued. But I don't believe you should stop buying appreciating assets, because you going to miss out on that appreciation if you wait.
COVID was a great example of that, wasn't it?
Yes.
What's home value is from 2020 to 2022? What, up 20, 30%?
Yeah, overall,
Especially in Lubbock.
Yeah.
It's crazy.
Yeah. And a lot of people think that that means it's going to crash, but it's not.
Because the dollar devalued.
Yes, exactly. That's where I was going. But so you miss out on all that appreciation if you don't own that asset until 2 years from now, that house, that whatever, commercial building. And so what if for 2 years you're paying 1.25 higher than you wanted to? Just refinance it when rates come down and make your money work smarter.
I think there's two things you need to consider, right? I don't care where the interest rates are. You have to divide your assets of what you're buying into is either passion or it's return.
Yeah.
So if you're going to buy a house that you're going to live in and it's your forever home, or it's your forever home now, right?
Yep.
And you buy it responsibly, it's a good buy.
Yep.
Right. And that's really, when I mean buy it responsibly, you know, I always say 25, 30%. I don't know what the rules are, but I always tell people don't buy over 25% of what your income is.
Yeah.
I don't know what the technical rules y'all use, but
well, we don't really have that kind of a technical rule, but go on.
yeah, the 25% is a good thing.
Yeah.
You know, spend 25% on your home. A lot of people say it's 30 or 40, but 25% is where I'm kind of at. Don't exceed that, right? So that's the first metric. Two is if it's an investment. And so if the investment is you make all your money on investment
Yeah.
real estate property on the front end of the transaction, not on the back end.
Yeah.
Everybody thinks they make money on the back end when they sell it. No, you make money on the front end when you're buying a good asset at a fair value or a below fair value. You see what I'm saying?
Yeah.
Knowing that it's an appreciating value
Yeah,
in the long run.
exactly.
So you can always refinance it if you have good equity in it and it's a
Right.
good asset.
Right. And it's not just knowing that that investment property is refinancing, but somebody else is paying for it because you're renting it to them.
So let's unpack that for a second. So how does that work, right? So I got one question for you because I get this question probably 50 times a year, more than that. How many homes can you own as investments before you have to go to conventional? And what is the difference between conventional financing and government, if it's Fannie Mae and Freddie Mac 30-year fix financing? Because this is important.
So what you're really asking is the difference between bank financing and Fannie Mae and Freddie Mac. Because conventional, Fannie Mae and Freddie Mac call their loans conventional.
Okay,
right? So going to a bank and getting a loan at a bank to buy an investment property versus doing it through the regular long-term mortgage rules. Couple things. One, a bank's not going to give you a 30-year loan to buy that investment property.
They typically give you a
15 to 20.
correct,
Yeah.
right? That's where I'm at, right? 20-year loan, and
Yeah.
then they reprice that loan
Right.
every
Right.
3 to 5 years.
Yeah, they give you an adjustable rate, and it's fixed for that 3 to 5 year, and then they reevaluate it based on the current market.
So if interest rates go up,
You're going to get a higher interest rate. But
Yeah.
if they go down, you might get a lower one.
I know,
too.
but there's risk there.
Right.
It's not guaranteed,
No.
right? And
No.
so the other scenario is a
A
Fannie Mae, Freddie Mac, which is a
conventional Fannie Mae, Freddie Mac loan. You can't do a FHA loan on an investment property. It has to be your primary residence, period.
okay.
That's a hard rule. But on a conventional Fannie Mae or Freddie Mac loan, you can own up to 10 finance properties.
Or 9 plus your primary residence.
Right. Yeah, I was going to say your primary is included in the 10.
Okay.
If you if your credit score is 720 or below, then you can only own 7.
Oh, I didn't
Credit
know that.
score is 721 or above, you can own 10. So how do you do that? You're going to have to put at least 20% down. On
So
that
you get out of
investment property.
PMI right there.
Yep. And you're going to get a better interest rate if you put 25%, just because it's a little less risky to the lender if you happen to default. And your interest rate is going to be a bit higher. My way of thinking is who cares? Because the way rents have gone up, you're going to be able to debt service that loan through the rent. And if you keep that house for the whole 30-year term, now you've got an asset that's appreciated 3% a year. So 3 times 30 is whatever, 90%.
Yep. Well, it's compounding, but yeah.
Yeah, right. I mean, more than 90%. And someone else paid all the debt on that loan.
Yeah, that's what, and I think, so you got 3 things working for you, right? So somebody else is paying the debt, right? You're getting to borrow an asset at 75 to 80% of its value, okay?
Yep.
Then you get to depreciate that asset out. So
And-
you're not
and-
paying taxes on the asset,
Right.
and then you're generating income off of it.
Right. And you have the appreciation over time when you decide to get
That's
out of it.
4. I'm sorry. There's 4 really good reasons. And I'm not promoting real estate, guys. I can't do that. But I'm saying this is why our society is built on real estate. This is why you asked earlier why the IRS will not change these rules. Because, there's things like 1031s, which we're not even going to get into. There's things like cost segregation of real estate that we're not going to get into. But there's things that there's huge advantages inside of real estate that no other asset class ever even gets to come close to controlling or having a piece of. So there's so many advantages into those if they're done right. But it really comes down to you and the mortgage side of it is if you do it right, you finance it right, you get the right rent rates or it's your forever home. So you got to really have that deal that says, don't overspend, live modest. And I lived in my first house that we bought for 15 years. And I was pretty successful in what I do today, and I still live there.
Yeah.
But my mindset was, I was paying like $800,000. $800 on the house, on a house that I bought for $80,000.
Yeah.
And so this is 15 years ago.
Yeah.
And we ended up selling that house for almost 170.
Yeah.
And so more than double. But it gave me that time to stockpile so much capital that I didn't have this huge, and I think that's where a lot of people overbuy their primary residence.
Yeah, right. And look at Warren Buffett. He's still in the ranch-style house that he bought however long ago.
It's nuts.
Probably 50 years ago now or more.
Yeah.
And he's the wealthiest guy, one of the wealthiest guys on the planet. So, yeah, there's something to learning to live
below your means and enjoy what it is. I worked with the guy. He was worth probably $300 million. And one of the wealthiest guys in West Texas. And he built it was one of the largest homes, not only in Texas, but I'm talking going all the way back to California and all the way to coast. I mean, it's a massive home. And it took him 4 years to build it. I think it's like 25,000, 30,000 square feet.
Wow.
Yeah, I mean, it's crazy. And pretty cool dude. And I was like, after doing it, and he was telling me about his mantle, and it was just this, I mean, massive thing, and it's just gorgeous. And I go, after doing that, he goes, Brendan, I got to tell you, man, like after living in it for a year or two, I was like, you don't even see it anymore.
Yeah, right.
It just becomes a thing that you walk past. And so I think a lot of people just kind of get off on saying, I got to keep up the Joneses and making sure all that stuff happens.
Yeah,
and
I think you're right.
You can live in that, and that's why I never really valued assets. And
we could get into some really philosophical stuff on that, but the bottom line is happiness doesn't come from those things.
From material
things. You can enjoy them, and that's great. But if you're not already happy in here, the luster fades.
And you then want something bigger and better.
Yeah.
Right.
It's like my car. Everybody in town knows I have an Audi, and they're all
that's faster.
But yours can't go 200 miles without having to run out of battery.
I think that's 220.
Okay. Unless there's a hill. But anyway, like that car doesn't make you happy, and that car doesn't make me happy. I'm already happy. I love my life, and I get to enjoy that car. But if I had to sell it and drive a Nissan Sentra or whatever,
you're good with
who cares?
I look at things like a car, and the reason I bought it is that autopilot. I want to buy back my time.
Oh, yeah, that's a good idea.
Yeah, and I think that's
mine can't do that.
Yeah, that's the only thing I can do is buy back time, because there's so many times I got to be on the phone call or I got to send a text or something like that, and I'm paying attention to the road, but everybody does this and tries to text while they're driving, right? And it's so dangerous, and I never promote that. Like, don't do it, right?
Yeah.
But when you can hit the autopilot button and it's 5 o'clock in the morning and I'm going 100 miles an hour down the straightest road in the world from Lubbock to Amarillo, and there's nobody on the road, it's nice to hit the autopilot for a second and send a 10-second text and know that I can still focus on the road, but I don't have to have my hands on the road for 10 seconds.
Yeah.
Or this is the most annoying thing, is open up a Coke.
Oh, yeah, right.
And you're doing it with your knee, and you're doing it. Yeah, right. So anyways, I digress. All right, so we talked about all the things inside of finance, right? Inside of how you get a mortgage. The one thing we haven't talked about is really the pitfalls of it. Like, where can it go wrong?
Well, you said it a few minutes ago. The biggest where you can go wrong is when you overbuy for what you can afford.
I think that's right.
I think that's probably the biggest one. And the next biggest one is location. If you're going to buy real estate, you got to buy it smart. You got to buy it where it's going. Like in this town, being a college town, I mean, there's a few areas where you wouldn't want to do it, but most places you can buy a rent house and never have to worry about whether or not you're going to keep it full. Mm-hmm. And of course, I would say another thing, might get struck by lightning, but people buying houses to Airbnb, the market's super saturated in Lubbock for Airbnb. So there's going to come a time where those are not going to be as profitable.
Don't you think the regulations are going to come down on those?
Yeah, probably. Mm-hmm.
So I think it's already started in a lot of markets, but I think it's going to get worse.
But so I'd say pitfalls are definitely overbuying for what you can afford and location and quality. Don't buy a house that is already falling apart and you don't have the means to, fix it back up and try to think that's going to make you a ton of money over the next 30 years.
Okay, so touch on that for a little bit because I think that's interesting. There are some different ways where you can finance real estate. So So you can finance real estate on, and I got Casey Klingensmith's a good buddy of mine.
Yeah,
and so,
mine too.
Yeah, right. I'm sure. And Casey's awesome. But he was like, "Hey, Brandon, you can go get financing where you can actually finance the remodel itself, and then you get the loan off of it's TVA or it's
ARV.
ARV. Thank
As
you.
repaired value.
As repaired value.
Yep.
So that's
going to be a bank loan, not one of these government-backed Fannie Mae, Freddie Mac loans.
Mm-hmm.
So here in town, there's a few banks that'll do that. Credit union too. We are not big enough to be able to do that, which doesn't matter. But yeah. So you can get an appraisal based on the plans you have for remodeling or adding to or whatever you're going to do to that house, flipping it. Most people say, and they'll loan you the money to purchase it, and probably except for maybe 10%, the
money to remodel it.
Yeah. Yeah, and then you do the work, and then that loan, usually that is going to be on their books, one of those adjustable rate kind of loans or interest-only loans, and when you're done the remodel, they're going to want it put into something a little bit more permanent, like a 20-year loan on their books or whatever.
Mm-hmm.
So, yeah.
So you're going to have to refinance it twice.
Well, not necessarily, because some banks will do the whole 20-year loan, and then they keep track of you actually doing the work that they loaned you the money to do. So they don't have to refinance it. Other banks are going to do 2 loans. It just depends on who you're dealing with.
So what else is going on in the world?
In my world, well, just having a blast with grandkids and kids and daughters-in-law. And my oldest grandson broke his leg. Both of the 2 bones in the bottom of his leg broke him right in half.
Doing what?
He goes to the gym with his buddies. He lives in Austin. And
how old is he?
14.
Oh, okay. So he's not like
a
7-year-old.
No. 14 and his buddies after school. They live in a neighborhood in Austin called Hyde Park, which is similar to Tech Terrace where I live. Older homes, and there's shops around, a lot more than in Tech Terrace. But the gym is 2 blocks away, and he and his buddies walk there after school or whatever. And so one of his buddies is 2 years older than him and probably 60 or 70 pounds bigger than him.
Oh, my goodness.
And after they worked out, the buddy said, "Hey, let me show you my latest kickboxing move that I learned."
Kicked him on the shin and broke his leg?
No, I don't. However he kicked him, they both lost their balance, and he landed on Nate's leg, and Nate's leg was pinned somehow, busted. That poor kid, all night long, 2 different hospitals because the first one couldn't handle it, and then they had to ambulance him to the second one. Finally, the orthopedic surgeon came in around 5 a.m. and said, "I don't know why you guys are messing with this. He needs to go to surgery." So he got a rod in his leg from his knee to his ankle.
I broke my tibia and fibia.
Those are the ones.
Yeah, and playing football in high school, it ended my career.
Yeah.
And so I planted my foot, had ankle braces on because I had really bad ankles, and it literally like snapped it. And so I'm laying on the ground, and my foot's laying the opposite direction that it should be. And so I kind of know that. I didn't have to do the rods, but it was right below my growth plate. And this is the reason why I'm only 5'9" on a good day.
Oh, yeah, right. Baloney. Yeah, you might only be 5'9", but you pack 6'2" into that 5'9". For sure.
You think?
Yeah, I've known you long enough to know that. Yeah. Keeping up with you.
I don't know.
I pray for Jennifer every night. No, I'm kidding.
Everybody needs to pray for Jennifer. She's my wife, but everybody needs to pray for her. But we balance each other out pretty well.
Yeah.
Yeah, because she's the most reserved person I think I've ever.
Yep.
But she can crack that whip on me pretty well too.
Yeah, well,
she has
right.
to.
Yeah,
you know what I'm
that's
saying?
Right.
It's a good deal. But there's man, I think this is a pretty good stopping spot, to be honest with you. So is there any, how can everybody get a hold of you? Because here's one thing is I can't endorse anybody, but I can tell them that I trust you, right?
Nice.
And
Thank you.
so, that you'll actually work hard for them. So how do people get in contact with you?
My cell phone is the best way, 806-773-0496.
That's an 806 number in Lubbock, Texas, but this is what I thought was interesting that I learned from you a little while ago. You're actually servicing loans all over the country.
Yeah, I do loans anywhere. Mm-hmm.
That's crazy because you had somebody that was like, you're doing a loan in Maine.
Mm-hmm. Yep. I've done them all up in New England. A few of those were family members because that's where I grew up. But yeah, North Carolina, South Carolina, all over the place. California, that's kind of a hard one to do. But yeah, and here's the thing. If you're a bank or a credit union, you are licensed in all 50 states to do mortgages. If you're an independent mortgage banker who's not working for a bank or a credit union, you have to get licensed in each separate state. So most independent mortgage people will only be licensed in maybe their state and the
a couple of
surrounding
surrounding ones.
states. Yeah. But because we're regulated by the federal government, we are grandfathered in to be able to do mortgage loans in any state in the union.
That's nuts. And so you work for a pretty good university bank here.
Yeah,
I got to tell you,
yeah, Texas Tech Federal Credit Union. Yeah.
Yeah. So shout out to Patrick Mahomes here a little bit.
I
So,
know, huh?
right?
Yeah,
That's
good for him.
Yeah, it is good for him. Winning another Super Bowl and MVP,
Yep.
both regular season and Super Bowl MVP.
I know.
and
yeah.
everybody
He's such
makes-
a quality guy.
He is. That's the thing I like about him the most.
Yep.
Is the guy just loves the game. You could tell that.
Yeah,
but
he does.
he's amazing to watch. But
And
he
he-
is a good West Texas boy here.
And he certainly has turned a lot of Lovekites from being Dallas fans to being Kansas City fans.
I'm one of them because I can tell you every single player on that Kansas City team. In fact, my wife gets annoyed with me. The guys at my office get annoyed with me on how much I have a conversation about the Kansas City Chiefs.
Yeah,
So
well, they're good.
they're good, but it's just a good organization, or it
Yeah.
seems to be from the surface. You know what
Yeah.
I'm saying? It's pretty
And
good. But
Kansas City's an awesome place to visit.
I haven't been there yet.
Oh, you should
It's
go.
on my bucket
If
list.
you like barbecue, go to Kansas City.
Really?
Burnt ends is what their specialty is.
That's coming
brisket.
down here in West Texas because
It
barbecue
is.
in Texas is not bad either.
No, it's not. You're right.
But
I love
it's-
Texas.
Yeah, I do too, man. But Tom, I appreciate you coming today, man. It's good to
too.
see you. And,
Yeah,
and
thanks.
thanks, man. I learned so much off of this episode
Oh,
that I
man.
have not done or
Well,
figured out. And
I learn something every time I talk to you, but I have to really listen fast.
I felt like I slowed it down, Ryan. Did I
You
slow
did.
it down a little bit? No, no, I didn't. Not at all. It's good to see you, Tom.
Yeah, same here. Thanks.
Thanks, buddy.
Appreciate it.